The S&P 500 just hit an all-time high of 6,932 points. It's being fueled by this massive AI boom and a kind of relentless optimism that 2026 is going to be all about stable growth.
It is. The entire financial world seems to be pricing in a future of smooth sailing.
High corporate margins, everything looking up.
But if you go below that surface,
Unbreaker?
beneath the party on the main deck, the foundations are seizing up.
Yeah.
The entire structural architecture of global governance, from alliances to monetary policy,
Yeah.
it's showing these critical fault lines.
A deep structural collapse.
Exactly. The divergence between what assets are worth and what's happening in the real world is, I think, approaching its absolute limit.
This is neural pulse. Let's analyze.
Yeah.
We should start where that chaos is most visible, which is the accelerating situation in Ukraine. All the signs are pointing towards some kind of forced peace agreement. The key piece of news is that President Zelensky's 20-point plan is reportedly 90% finalized.
And that's ahead of his meeting with Trump at Mar-a-Lago on the 28th.
Right. We've seen an evolution from that earlier, more Russia-influenced plan. But the military reality on the ground remains harsh. Russia still controls over 70% of the Donbas.
And that's the key. This isn't peace from goodwill or exhaustion. It's a textbook case of peace driven purely by U.S. pressure. A true forced peace.
So the real insight isn't the deal itself.
No, it's the details being leaked. Specifically, Ukraine's insistence on maintaining an 800,000-person standing army as part of any deal.
That number, 800,000, seems hugely consequential, especially if they're supposedly entering a peace phase. Why that specific figure?
Because that is the hedgehog signal. It's a defense strategy focused entirely on self-deterrence. If they accept a neutralized buffer status, which is what the West is pushing for, they instantly lose NATO's Article 5 security guarantee.
So if they can't rely on the NATO shield, they have to become the shield.
Precisely. They're signaling the only way forward is to be so heavily armed, so costly to invade again that no one tries. That's what the 800,000 troops are for. It's an insurance policy.
And meanwhile, Russia's actions on the ground are intensifying. The infrastructure attacks are getting worse.
Of course. It's a classic military negotiating tactic. You escalate to de-escalate.
Hit them harder right before you sit down at the table.
You knock out power grids, disrupt logistics, you solidify your positions and maximize your leverage right before the talks freeze everything in place.
That pressure on Kyiv is one kind of transactional policy, but we're also seeing the U.S. apply a much harsher and more ideological pressure elsewhere.
Yes, in Nigeria.
On Christmas Day, U.S. airstrikes against ISIS forces in Sokoto State, AFRICOM confirmed them as powerful and fatal.
Look, the counterterrorism mission itself is routine, but the political framing is a profound strategic shift. The president explicitly justified it as, quote, retaliation for the persecution of Christians.
That moves U.S. foreign policy into a very different space, doesn't it?
It does. It moves it toward this aggressive ideological interventionism, and that's a huge risk.
By framing it that way, you risk doing the opposition a favor, right? What's the potential blowback?
It's the Cobra effect in action. By framing the strikes in purely religious terms, the U.S. inadvertently gives groups like ISIS and Boko Haram this incredibly potent narrative.
That they're fighting a Western crusade.
Exactly. It elevates them from criminals to religious warriors, which could drastically increase recruitment across the Sahel. And on top of that, it creates friction with the Nigerian secular government, and, it could push them to look for other partners.
Like China or Russia.
Who will sell them weapons without asking about religion. It's a very high-risk gamble.
And this focus on narrow gains, whether it's in Kyiv or in Africa, is now showing up in the digital world, which brings us to hybrid threats.
And how they impact civilian life.
We saw a clear escalation in that gray zone this week. The French National Postal Service, La Poste, and its bank, La Banque Postale, were hit by a massive DDoS attack.
And the timing was surgical. It started on December 22nd, right in the middle of the Christmas delivery and shopping period.
The pro-Russian group, No Name 057, claimed responsibility.
They understand the target isn't the server hardware. It's public patience. This is what we call cognitive warfare. A non-physical attack aimed directly at the psychological stress points of a population.
So the goal isn't to steal data or destroy anything permanently. It's just to make the French government look incompetent by disrupting mail, digital IDs, online payments, all during the holidays.
Exactly. You hold citizens and their routines hostage. It creates societal stress, discontent against the government that supports Ukraine, and because it's non-lethal and falls below the threshold of physical destruction,
It stays in that gray zone. It avoids triggering a NATO response.
it falls far below the standard for Article 5. And that makes it frustratingly difficult to defend against. I would expect similar attacks on core European logistics. Think about rail scheduling in Germany, ports in the UK, during this holiday travel surge.
Now, shifting from digital attacks to the markets, oil is showing some severe dissonance. Brent crude spiked recently to around $62.40 a barrel.
A pretty vertical move up from the $59 range.
Right. And this is happening even as the International Energy Agency is predicting a huge structural supply glut for 2026, something like 3.84 million barrels per day.
Logically, that glut should be driving prices down, not up.
So what's happening?
What we're seeing is a classic artificial floor. The price is being propped up purely by geopolitical risk premiums. It's totally decoupled from supply and demand.
And what are those premiums?
Two main factors right now. First, the U.S. naval quarantine, which is basically a de facto blockade of Venezuelan oil tankers, their shadow fleet. And second, military action like the strike in Nigeria. That creates this generalized fear of disruption.
But hasn't the market always priced in geopolitical risk? Why is this equilibrium more brittle?
Because the fundamentals are actively fighting it. Last year's supply was tighter. Now the IEA is forecasting a massive structural glut. The whole price above, say, $50 is a premium tacked onto an oversupplied commodity. If either of those risk factors eases up, that premium vanishes overnight.
Which means we're facing the risk of a reverse oil shock.
Precisely. If the global economy slows down in 2026 and tensions cool just a little, say a Ukraine ceasefire, that premium peels away fast. We could see Brent plunge back to the low 50s, maybe even lower.
Who gets hurt first in that scenario?
Well, it cascades. It's devastating for producer states first. It cripples their budgets. But then it stresses the whole financial system. Energy funds, debt-laden shale producers, banks exposed to petrostate sovereign debt. It's a mess.
That kind of economic instability is really being felt in Asia. Let's pivot to Japan. The central bank is walking a monetary tightrope.
They are.
The Bank of Japan just raised its policy rate to 0.75%, which is a 30-year high. But the new data shows core CPI in Tokyo actually slowed in December, from 2.8% down to 2.3%.
I was still above their 2% target, but it is slowing. And this is happening alongside that record expansionary Daikaichi Doctrine budget. So you have high spending and high rates fighting each other.
How did the market read that?
The market saw the slowing inflation and decided the BOJ lacks the conviction for more aggressive hikes.
And why is that market conviction so important?
Because without it, the rate hike is ineffective. The lack of faith in future tightening immediately pushes the yen weaker. It's around 156 to the dollar, which is a real concern.
A weak yen creates cost-push inflation. Imports get more expensive.
Exactly. It's a policy trap. They have to choose between tightening into a slowdown or letting inflation run hotter. But the real pain point for 2026 will be households with floating rate mortgages and all those debt-dependent small businesses. It's a classic squeeze.
And those strains we're seeing in Japan, that struggle between spending and consumer tightening, that's being reflected across Asia, especially in China.
Yes, specifically in the global luxury sector. It's causing chaos.
The structural slowdown in Chinese demand is forcing a major crisis for global brands. Bain & Company is projecting the mainland Chinese luxury market will be flat or shrinking in 2025. That's a huge pivot.
A massive pivot.
But the data point that really tells the story is the secondhand luxury market. It's just exploded from about $8 billion in 2020 to $30 billion this year.
That is the great bifurcation in action. The structural shocks, real estate crisis, youth unemployment have fundamentally changed consumer psychology. They're risk-averse now.
So they're not just tightening their belts.
No, it's a total reset of priorities. They are shifting away from intermediate visible logo brands, the kind for flashy status displays, and moving toward either high asset value brands like Hermes, which hold their value like a stock.
Or they're spending on experiences.
Right, high-end experiences. The strategic imperative for these brands is to de-risk from China and urgently refocus on India, Southeast Asia, and the resilient U.S. market.
Let's transition now to some rapid-fire instability updates, which really confirm this breakdown of the global order. We'll start in Africa. The RSF siege of El Fasher in North Darfur is in its final phase.
A terrible situation. It's the last RSF stronghold in the region.
The humanitarian cost is beyond critical. 13 million displaced and horrific reports of systematic violence and rape.
This is the tragic, definitive breakdown of the responsibility to protect, or R2P, doctrine. The world is actively ignoring it. It has low strategic priority, no impact on oil prices or shipping lanes.
And there's external interference?
The UAE and Russia are heavily involved, prolonging the conflict. The so what here is enormous. We have to expect the potential for massive ethnic cleansing and maybe even the formal state partition of Sudan.
Okay, next, Bangladesh. A major political event on Christmas Day. Tariq Rahman, the key man of the opposition BNP, returned after 17 years in exile.
He was greeted by thousands. His return dramatically raises the stakes for the 2026 election, but his history is crucial. He has a long history of corruption and association with political violence. The risk is that the new regime will just be a substitute form of instability.
And in Russia, the internal tightening continues. The leftist pro-war Putin critic Sergei Udaltsov was just sentenced to 6 years.
And the significance there is that Udaltsov wasn't a liberal dissident. He was a hardline pro-war leftist who just criticized how the war was being fought. It confirms the regime is closing the space for any critical voice. It's a sign of desperation.
Finally, let's look at the strategic triangle between the superpowers. U.S. intelligence reports China is actively trying to disrupt deepening U.S.-India ties.
And this confirms India's highly successful multi-alignment policy is working. They are playing the U.S. and China against each other beautifully. By normalizing the border with China while deepening ties with the U.S., they maximize their autonomy and cement their status as the leader of the global South. Beijing's frustration is Washington's best indicator that India is winning.
So if we synthesize all of this, from Ukraine to Sudan, the world is clearly in this interregnum, a dangerous period where the old global order is gone, but a new one hasn't replaced it.
Right. And the main takeaway for you, the decision maker, is that you cannot be misled by euphoric market headlines. The true structural risk for 2026 is the rapid, potentially explosive correction of that gap between high asset valuations and real-world fundamentals.
That gap is closing.
And when it snaps shut, it's going to be painful.
Let me leave you with this thought to mull over. We're seeing a shift where U.S. military force is becoming overtly transactional and ideological, think Nigeria and Venezuela, yet traditional humanitarian conflicts like the collapse in Sudan are just left to fester. Is global power shifting from managing broad stability to just maximizing narrow national interest deals, regardless of the chaos left behind?
Neural Pulse. Clarity in a complex world. See you tomorrow.